Canadian investors are using ZSP over any other ETF for exposure to the S&P 500 index. Institutional investors, investment advisors, and DIY investors have all been trusting ZSP with their investment dollars since the fall of 2012. ETFs provide instant access to a portfolio of stocks to an investor in a single, cost-efficient trade. For an investor to own the entire index would require institutional-level trading systems and expertise. To accomplish this, an investor would have to buy 500 stocks at a time, and then as the market moves, it would constantly have to rebalance those 500 stocks several times a year. ZSP simplifies this process by aiming to provide instant access to the 500 stocks in the index in a very easy and low-cost way.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 145. As always, joined by the three amigos, Boomer, Keith Dicker, IceCap Asset Management, Rich Diaz. What's going on?
I'm in Montreal, guys. City of love. Right, Rich?
Right. Definitely the city of love.
Do you know why it's the city of love? I'm going to tell you why. Because
I was going to say the strippers, but okay, never mind.
Well, my story is a bit more genuine than yours, I guess. I was here back in the late 90s, probably 27 years ago or something like that. And that's when I had a little very quick talk with myself that I should marry Mrs. IceCap. I should ask her. That's where I was here. Yeah. And yeah, so it's a very important part of my life, of course. And, 25 plus years later, it still worked out. So I call it this. No, that wasn't involved at all. I have a lot of love for this city for that reason. But Rich, you seem to be on a different
Well, that is
angle.
Way more wholesome than I was. I'm now embarrassed and ashamed, and I apologize. That's a very nice story. That is all. I have nothing
That's
anyway.
It's a tough one to recover from, though, isn't
No,
it?
that is, I cannot recover.
Anyway, I'm here for the Loonie Hour piss up. Social event tonight with Rich and a few friends. Very excited about that.
You guys are going for tomahawk dinner?
Tomahawk streak might end. It'll continue, but it won't be a tomahawk, I think. Whatever the Montreal version is.
Is that not kosher in Montreal? Tomahawk?
Oh, there's a bunch of really nice steakhouses here. But Keith got wind of this very bougie, shishi poo poo French restaurant, so that's where we're going.
And they have dedicated bike lanes just to get there.
Well played.
No comment.
What else is going on? Do you see in the news there? Obviously, we probably can't help but avoid the attempted assassination there.
Yeah.
A lot of conspiracy theories floating around on the internet.
Which one's your favorite?
Keith started like at least 5 of them.
I don't think that's true. But on a very serious note, it was, a very big event, of course, that's not only had an immediate effect on not just the US, but the world, and it's reverberating. Is that the right word? Everywhere. Yeah. A lot of people have said, hey, this is, the political year from hell for a number of reasons. Here in Canada, we're seeing some things like that. I don't mean in terms of assassination, but, very dramatic swings and sharp views. The stick is sharpened on both ends, in Europe as well. But this was it was, I don't even know what else to say about it, really. There's lots of different ideas, what happened, what didn't happen. We're not going to go into all the stories on it, but it's very clear it was, a bit of an F up or, some assistance put in there. But
a sloped roof.
A sloped roof, that's dangerous, of course. That's the best one.
I have a bit of a story, actually, not about it, but I was up north on the land. I was up, up in northern Quebec, and I have no house just yet, and certainly no internet or reception. And so there I am minding my own
Starlink?
business. No Starlink just yet. And I kind of put my phone away on purpose. And so there you go, just chopping wood, making fire, drinking my whiskey. And I basically missed it. I might have been the only person on the whole world who didn't know what happened until late Sunday night when my phone exploded. And I was like, no, this has got to be some kind of hoax or whatever. Only to find out that, yeah, geez, it's pretty scary. But anyway, there you go.
Well, of course, to top it off, then, Biden miraculously develops COVID. So he won't be attending the DNC, the Democratic National Convention coming up, I don't think. And so I think we are going down this path. And I mentioned this before. Whoever they is, your air quotes, they do not want or cannot have Trump in power. So they have to stop that. It almost happened. But I suspect the next step, though, it will be probably increasing the probability of war, a global conflict before an election. Yeah, I know you don't like to hear it, but
I
that's
just don't agree.
Kind of where we're going. It's okay. But a lot of people didn't agree that there would be an attempt on his life. And
that's not
that
true.
happened as well.
No, people have been saying that for months. Anyways.
Yeah. I don't think it's a one-off event. I think this rhetoric is going to continue.
I mean, it's interesting from the fact that, you were a millimeter away from what could have been a civil war in the US.
I don't know. 4 presidents have been assassinated. The only one that was related to the Civil War was after it. And then there's been multiple assassination attempts. This is par for the course for America, as far as I'm concerned. I think we forget a little bit of our history, but I don't know.
Well,
anyway. Did you see the Rich? I know we were talking about it before we started recording the DEI, diversity, equity. So did you see the one security guard?
I did. It was too much.
I'm sure she's a really nice lady, but it's going all over the internet. I remember I was watching the clip originally. I was like, what is she doing with her gun and her holster? And that's the whole meme going around the internet right now. But
well, then can I just touch on another thing related to DEI? Because I think and ESG. I think those two are inextricably linked with real interest rates that are negative and held there for much, much longer than they should. And they create enormous misallocations of capital. And I think DEI and ESG and all this rest of this stuff I think maybe that's a conspiracy theory, but I genuinely believe that they're linked. And it's funny that Microsoft just came out and said that they're closing down their DEI thing. It's no longer, quote, I think mission critical or something like that. I think people are walking away from it. And I just every once in a while we get something right on the Loonie Hour, and I'd like to pat ourselves a little bit on the back, because I think we'll see this more and more as it becomes as the fashion trend sort of shifts into a different direction, as we, I think, accurately highlighted it was just purely a marketing shtick, and marketing follows fashion, and fashion trends change. And I think that's what we're seeing. But it was a funny meme.
There was a good chart actually from Bloomberg showing the demand for ESG roles. So they showed the growth in employee positions in New York. So it actually kind of peaked in early 2022 at 28%. And it's now down to 4.8%, which is the lowest it's been going back to 2017. So
did you just say that 28% of job openings were DEI related?
No, the growth in ESG roles at one point actually hit 30% in 2022, and it's now down to 4.8%. So it's just showing the growth in ESG roles on a year-over-year basis. And so people will say, well, the labor market's slowing. But like I said, if you go back and even look at 2017, 2018, 2019, it was still growing around 15 to 20%. So right now we're growing at 4.8.
There she was.
I mean,
it's
gone
now,
Rich.
Rich.
Slowing. We'll see. I could be wrong, but I suspect it has a lot to do with excess liquidity. And I think I think it's probably, maybe it's a coincidence, but I think, what did you say? Mid 2022? I think that was probably peak.
Yeah, I mean, that was
end of that excess
to be
liquidity.
fair, that was the peak for a lot of things.
Yeah, it's true.
But now, though, in our world, there's a lot of product built on ESG.
Yeah.
a ton of it. And now the way the investment world works, remember, they're always trying to get your money, Steve. They want your money bags. They can't sell any more of that because they stuffed it to the brim. Now they'll move on to the next one. I don't know
What do you
what's
think
the next one
is? Yeah.
Oh, I think it's going to be at some point. I think the biggest opportunity coming up is in the debt world, the credit market, but that's after the collapse, after the crash. So that'll be like credit recovery kind of fund.
Well,
But you can't have a recovery fund until you have the crash first.
It's true.
Because it's hard to market, Rich. It's really hard to market a recovery fund if it's nothing. Like you can't have the NVIDIA recovery fund. Or maybe we
No, you
can at
can't.
this point.
2% dip.
This is not investment advice.
Go ahead.
No, I was just gonna say, speaking of like, I'm careful to say this, but speaking of like crashes before the recovery, there's a lot of, we're talking about, market concentration and sort of a lot of, as far as, highlighting some weakness that we're seeing with respect to things that are unsustainable in the market. We're seeing high yield bond optionality, with respect to, option adjusted spreads, excuse me. If you look single B versus triple C, so things, really close along the ratings line, they tend to move together. We're seeing like a split. We're seeing triple C option adjusted spreads rise, which has happened before the dot-com bubble, which happened before 2008, which happened before 2015-16 recession and 8. So there, and then there's like other stuff that's happening. I mean, there's there's the equal weighted versus S&P 500, which is market cap weighted. And sort of the rolling returns of those are completely out of whack. That's related to market breadth and market concentration, and that also sort of as a precursor to a market correction. So, it's getting interesting. Sorry, Steve, what were you going to say?
Yeah, I mean, actually, it's interesting just to tie us all back to our initial conversation around the Trump, assassination attempt, and obviously his polling numbers have gone up, or his probabilities of winning the election have gone up significantly since that event. And we're actually seeing financial markets react to that news as well. Kind of seeing rotation out of the big tech names and into sort of small cap. So Keith, I don't know if you've been paying attention to that, but there's been some pretty violent moves in the last week.
Yeah, markets don't care really who wins. They just want more visibility or clarity of who was going to win. Because then, if someone's policies, again, they are what they are, then which way it should have an impact on markets. So maybe that's what's happening as well. But remember, whenever you have big market moves, the media needs an instant narrative on why it's moved. Yeah. So maybe that's what, or maybe it goes down to what Rich just introduced a couple minutes ago. People are saying, hey, I've made some money in this part of the market. I want to take some profits and reallocate to another part of the market. By the way, Steve, I think Rich just did call the top of the market. So were you called the bottom in the market in real estate a while back? I think Rich called the top. So
we got a top
we'll
caller.
put do a timestamp on it for this one here. That's gutsy. That's gutsy. Well done, Rich. July 18th. So if you're watching this, it's probably July 19th now because we record on Thursdays.
Oh, God.
So it is the day after. But
well played, sir. Well played.
Yeah, that's interesting. We have that happening.
Rich front run all our listeners.
I think we have a big bet coming up today, right? We have to get into that at some point.
Yeah. Well, we had the Canada CPI, of course, came out this week. I didn't see any tweets from Chrysler Freeland, so maybe no happy dance this week. But Canada CPI came in lower than expected, 2.7%. The expectations were for 2.8. So we kind of went from, for those following along, we went from like 2.7. Previous month, we jumped back up to 2.9. And now we're back to 2.7 on a headline inflation basis year over year, of course. There's some underlying dynamic to that, which I think we can kind of pull out and whatnot. But Rich, I don't know if you had any initial comments.
No, I think it's more of the same. I think I'm surprised Christina Freeland didn't mention it because it's just more of a confirmation that the worst of the peak 2022, that year comes up again. That's long gone. Things like shelter component fell slightly, although they still remain high. Alcohol, beverage, and tobacco, which are extremely expensive in Quebec, they fell. Health sector fell month on month. Transport fell. So I think a lot of it had to do with the energy component. So gasoline was like a big contributor to that decline. But basically, it was basically across the board. Durable goods really fell a lot. So I think it's down almost 2%. So I think that's on a 12-month change. I think that speaks to sort of the issues we're having on the retail sales side because of weak consumption, certainly on a per capita basis, something we've talked about a lot. Stuff I always love to look at is grocery prices. So it accelerated for a second consecutive month. It's still low. It's at 2%, but it's still it's starting to reaccelerate, which I think is kind of interesting and weird. I don't really understand that.
Well, again, I find that always interesting from like a narrative perspective, right? Because people are going to hear grocery prices up 2%, and people are going to go, "No way, there's no possibility."
I get it.
I mean, price levels have obviously gone way higher. There's no recovering from that. They're not coming down.
Right.
They're still going up. They're just going up at a modest pace of 2%.
Right. Two more quick things. One was I always love my 3 preferred measures of inflation, which is common, which is a model-based one, which is median, and trimmed, we've discussed that as well before many times. And you're seeing 2.3, 2.6, and 2.9 respectively. So this brings us to the final thing, which I always love to mention, which is the mortgage interest cost, excuse me. And that's down from 20. So it was at 31 or whatever a couple months ago. It dropped to 28, now at 23, and now we're at 22.3. And then rents really are the only piece that continue to really rise, and we all know why, because of immigration. But Keith, what do you think? I think, do you want to crack on with the market-based stuff and what the BOC is going to do?
I think you both hit. Yeah, I mean, so first of all, the narrative is that inflation data points, they're slowing, right? And that's what everybody wants to see from a policy perspective. Everyone in the world wants to see rates get cut again, because apparently that will fix the housing market, which will affect retirement.
Everything.
It'll fix everything in the world. Right? And if that's the case, why don't they just drop them again, down to 0? With the data points that came out for the Canadian numbers, it does provide more, I guess, runway or leeway, for the BOC to cut rates again at the next meeting, which is next Wednesday, or this coming Wednesday, of course. I mean, they continue, like, in their minds. They already said they're going to generate a soft landing. So in their minds, that's already happened. We'll talk about that as well. And now they're going to generate another sort of soft landing in the inflation world as well. So the soft landing from economic world means no recession. Now they're thinking, hey, we're going to time this perfectly and get inflation back down to another number. I think that's going to be difficult to do. But right now they're happy. And maybe Wednesday, I suggest they're going to have another one of these enjoy the moment again day. Enjoy the party. So I think you know which way I'm leaning for the BOC decision next week.
Well, we'll get to that in a sec. But yeah, Rich, I just wanted to pull on a few threads here on the inflation side. And again, people can maybe interpret this however they want. So of the CPI inflation, you had rent inflation, which is the consumer price index for the rent inflation component, is still running. It's clocked in at 8.8% on a year-over-year basis. So that's the highest in 40 years. 8.8. Yeah. Now, I will say this, like, again, from my perspective, feet on the ground in the real estate market, rents peaked out in Vancouver, let's call it 12 months ago. I mean, there's lots of anecdotal data, and I mean, there's actually real-time data in the GTA that rents are actually falling in large parts of that market. And so I look at that rent inflation. We've talked about, grocery prices, how much they lagged on the initial way up. We talked about how much, a lot of these indicators are all lagging. And so it's interesting. And then you look at, a good friend of the show, Ben Rabideau, who's been talking about mortgage interest. And basically one of the reasons why we had the big uptick in headline inflation last month was because StatsCan actually increased the weighting of the basket. So they increased mortgage interest costs and how that impacts CPI inflation. But we all know, Rich, that from a base effects perspective, that is going to start to actually come out of the basket. And so you almost kind of wonder where these guys, like, you know what I mean? Like, don't be surprised basically if inflation undershoots 3 to 6 months from now as that mortgage interest component falls out of the basket.
I don't know. Because maybe in the sense that your contribution is starting to shrink. I get that. And X mortgage costs, it's still relatively low. But they include that in the doc. So if you look on page, shit, I've lost it now.
But if you look at rent inflation, which is like a significant, like shelter inflation is like what, 1/3 of the basket.
Yeah, it's like 40% of the core and 32 or whatever percent of it.
Right. And so like I think most of us agree, other than maybe Alberta, rents are dropping or flatlining in most of the country. And then you've got mortgage interest component, which is also another significant portion of that component is going to start, not that it's necessarily going down, but like the base effects are fading out. And so that's kind of my argument from it. I mean, I'm not saying that we're completely.
I don't disagree that it's going to fade out. I guess what I'm saying is, it's like it needs to go negative for it to become a drag, is what I was trying to say. Sorry, that's what I was trying to say. What I mean is the contribution is also going to shrink, right? It's volatility times the number. And if that volatility changes and the number changes, it's just going to shrink the drag. You won't have a drag or a contribution. I think that number will just become less and less important. That's my guess. We'll have to get Ben Rabideau back on the show to discuss that further.
Well, the next Loonie Hour pod's at his lake. You hear that, Ben?
But can I ask you just a quick question on this? So, like, there's a website called rentals.ca.
Yeah, they're pretty good.
Okay, well, that was my question. Like, do you it says like, Vancouver ranks as like the most expensive, and it says one bed is 2,700, which is nuts. And it says that negative, and it's year-on-year negative 7.5%. Is that right? I mean, that's crazy numbers.
No, I mean, that's tough. I mean, like rental.ca, I mean, they're doing their best, of course. I think they're one of the better ones, but they're measuring asking rents, right? And so, I mean, you and I can ask whatever we want. I mean, yes, it's showing that asking rents are coming down. There's some volatility in that data set from what I've seen. But the GTA really has the best rental data because their MLS system is really deep, and their MLS system tracks the rents. Whereas in Vancouver, our MLS system only just started tracking rents in the last couple of years, and not many people use the MLS to actually rent properties out. So like the two markets are very different in terms of how the rental markets operate and how they collect data. So, but I think the GTA is obviously, it's our largest market, and they have a really good data set for rentals there. And it is quite clearly showing that rents have peaked and are declining in quite a few of the markets.
But wait, Steve, one more thing. So you're saying, in effect, what you're saying is that the BOC is basically poised for a policy mistake. Because if you're saying that rents are actually already peaked, and that's what rentals.ca says. Rentals.ca said they peaked 12 months ago, as you've been saying many, many times. Rents peaked 12 months ago, which means your year-on-year change is going to collapse, which means that if the BOC is hawkish, and I guess we're about to talk about what our bets are, that actually interest rates should have already been cut a while back.
I think they're notoriously behind the curve. I mean, I think that, they started raising rates in March of 2022. I mean, the housing market literally peaked in February of 2022. In almost every market, it peaked in February 22. They started raising rates a month afterwards, and it's like they missed it. They could have easily slowed house price inflation 12 months earlier. Anyone that was in the industry, whether it was me, Ron Butler, Ben Rabideau, the list goes on and on and on. Everybody was like yelling on Twitter that like housing was like out of control in the early parts of 2021. So I don't know. Yeah, I do think from what I'm seeing, like, I don't think housing inflation, which is a huge component of the basket, is a problem today. So house prices are declining in most markets. Rents are declining in a good chunk of markets, and mortgage interest costs are going to start they're no longer going up.
Right.
So if your shelter, which is a third of your basket, is flat and or declining, I do think that that's going to be a drag on inflation for the most part. So that's my view.
Well, if we have any audience or listeners still here after that exchange,
come on, that was interesting, you jerk.
That was a good nerd fight. Nerd 1 against nerd 2. I don't know, guys. I'm not. One thing I can confirm is that yes, Ben Rabbit and I did have a nice dinner there a few weeks back, and we did decide to have a Loonie Hour event at his cottage up on the
So we're gonna
beach.
put it. The address will be in the description. We'll put the description. His address will be there.
Send Keith a DM.
Send Keith a DM for his address.
So to give you guys a different perspective on, you guys are trying to figure out which way CPI is going and core and trim and median and all that stuff. And like, God love you for trying to do that. That's fun. What's also happening though is that, the BC, the Bank of Canada, they are chatting with commercial banks every day. And there was an interesting quote came out from RBC, the RBC economic team. And, they say, their exact words were, even if it isn't a recession, it sure feels like a recession. And I think people would agree with that mostly. And they say, if it wasn't for the population growth, that Canada would absolutely be in recession. We've been saying that now for a while, and Rich, you were very early on that story as well. And but the fact that the banks are now saying this as well, and do we have skin in that game? Maybe a little bit, like us from the kind of work that all three of us do, but the banks have a lot of skin in that game, and so they are likely also echoing that to the Bank of Canada. So whether, the CPI data comes down to, 2.7 versus 2.8 estimate and things, I think they are very, very concerned that we do hit a hard recession. Again, one that has never been experienced in Canada in our lifetime, right? And so I can see them, no matter what happens, they continue need to, become dovish, to try to support something they don't want to happen. So again, I just gave you another little clue which way I'm headed for next week, Rich.
Okay, well, let's do this. We do.
And you're still not getting it. Rich still doesn't get it yet.
I'm not that dumb.
Nerd 1 versus nerd 2, and I'm the cool guy, right?
Yeah, person last time maybe.
Yeah. I was really cool in high school, by the way. One of the cool guys.
We believe you.
Okay, come on.
Yeah, I finished once in gym class, high jump. I finished 4th place. I was pretty.
Them jumping over you doesn't really count. That's not really the way that went.
Okay,
Those
guys,
short
we
little
were
legs,
at.
I doubt it.
You can see me run. So the BOC, they were at 5%, and then they cut to 4.75 at the last meeting. That was back in June, correct?
Yeah.
Yeah.
So July 24th, next week, next Wednesday, a day before we record the pod, we'll have the update. So what are the market odds right now, Keith? What's your Bloom Tubes telling you?
Well, I can tell you after we do our bet, or do you want to know before?
Well, I know what the market odds as of a day and a half ago were. I mean,
yeah.
So
it's pretty high. It's a 95% probability that
they're 95. I guess it depends on what metric you use, right?
Right.
Yeah, this would be the financial instrument trading it, not like economic estimates, I guess. But right now, basically the market. So this is actually good. So if there is a rate cut, hey, that's what everyone has been expecting. It should not impact the Canadian dollar, credit spreads or anything like that. If they don't, yeah, it's priced in. Absolutely, Steve. Yeah, if they don't cut, then all else being equal, unless something interesting happens again in our world, I know the Canadian dollar should strengthen quite a bit next Wednesday. But I'm down for a cut. I think they have another chance here to cut again, to ease up. That's what I'm down with. Steve, what is your call?
No, Rich, you're up, buddy.
Oh, Rich. Okay.
I vote no cut because I've been working out and eating clean.
Put your bias aside.
And,
they're cutting.
Yeah, I know they're cutting. They're gonna cut. but it's not as much fun. So I bet one Twinkie that they're not going to cut.
All right. Well, I'll let you have that, Twiggy. I'm going to go with the cut. I mean, Keith, from like a central banker perspective, I mean, clearly, these guys have to be looking at financial markets. If they see markets are betting in one direction, let's just call it 90% odds. I mean, that's just a shoo-in for them to cut. I mean, it would almost be odd if they went against that, would it not?
Yeah. So what would actually happen if they were thinking, hey, they may not? I mean, they're not going to call, one of the big banks 5 minutes before and say, hey, you're wrong with this, take the trade off. But they, they would be guiding
Nancy Pelosi.
Yeah.
Yeah. But they would be guiding, commercial banks on what they're thinking, or they're asking the questions, how are you guys positioned, for this? And because they don't, somebody will make money, somebody will lose money on it, but they don't want someone to really get hurt. So right now, again, with markets basically saying it's a done deal, they're going to cut. And if they're thinking, hey, this may not happen, you should see that probability, number come down. And that's what a good central bank would do that. So what do we have? What is the BOC? I don't know. Do you know?
I don't know either. Don't
I have no idea.
Jury's
you
still
know
out.
my views on TIFF.
He did tell us to enjoy the moment. So that
He also said interest rates would be low for a very long time. So,
I think it was very, very long time. Yeah.
Anyways.
Anyway,
so
let's just let that go then, I
let's
guess.
just call it what it is. We have pretty much a clear consensus that they're going to cut.
No, I'm
Except
not a
from Rich.
consensus.
Except
Well, yeah, okay, buddy, whatever. For the purposes of the bet, because you're desperate for a Twinkie.
That's right.
But there's pretty unanimous agreement here that this guy's going to follow the markets. They're going to cut. What's the rest of the trajectory here for this year? I mean, have we updated the number of cuts expected?
Yeah. So for year end, the market right now, it's saying that we should be at 4% for year end. So including next week, another 75 basis points cut.
Oh, it'll be another 50.
Well, 25 next week plus another 50. Okay. So 75 in total.
There you go.
And that's all for math class, the Loonie Hour.
Carry the one. Subtract 3 hours for the West Coast time, and then then you're there. Yeah.
Wait, I have a question. That's related to this. So do you think, let's say we end the year at 4%. I'm gonna be very fat by that point because I'm gonna keep betting that they're not gonna cut. Will that be enough, Steve, for the housing market in Vancouver, the listings in Toronto? I mean, isn't that really the $1 million question? Sorry to put you on the spot here, but I'm genuinely
you are
curious.
putting me on the spot.
Well, I called the top of the market, so
look, I think we still have a lot of troubles that are in the system that are working its way through the Python, so to speak. I think that the number of developer foreclosures is still coming through. I mean, we haven't seen. I think we've just seen the tip of the iceberg there. I think there's a lot of people that are like, these projects are just getting crushed, and they're just basically just going through the court system. So I think that's a real problem. And so, like, you have to ask yourself, the number of units under construction today is still relatively decent. Well, it's not decent, it's really high. But how we all know housing starts getting crushed. And so I do wonder, like, once those projects complete and there's not a lot of new projects that have been starting, what does the layoff cycle look like in that sector? And how does that filter through into the rest of the economy? Because I think construction is 9% of the labor force.
Something like that.
So I think that if you get rates down to 4% by the end of the year, I definitely think things will be moving. I think you'll have more transactions, right? You're not going to have a 20-year low in home sales, but I don't think that's necessarily equates to higher prices. I think that depending where your fixed rates are too, I mean, you could still be talking about a 5-year mortgage in Canada is still at 4% or 4.2 or 4.3%. And that's still a difficult adjustment for a lot of households that were borrowing at 2 and now are renewing at 4.2. So yeah, they might not renew at 5, but so I still think there's going to be some issues there. I still think that I don't know, like it's just hard. It's hard to predict. Do we just chop sideways for the next 2-3 years? I mean, we've that would be 5 years of basically no price appreciation.
Yeah. So something
That
we
would-
mentioned. Oh,
sorry to
go
interrupt.
ahead.
And just to add to that, like there's still a lot of condos that are under construction. Like the biggest trend that I see in Vancouver and when I talk to my contacts in Toronto is that all these people that bought pre-sales in 2021, 2022, 2023, predominantly investors, because that's who buys pre-sales. It's a futures contract. Those units are coming up for completion today, over the next 6 months, over the next 18 months. And when you close on them, the numbers simply do not pencil. They don't pencil. You can't carry the rent when the mortgages are at 4%. And so that hasn't changed. So the number one thing that we're seeing is people are closing on these units and everyone's saying, okay, I want to sell now. But they can't quite get their price. So the inventory is just kind of sitting there. It's piling up and they don't want to rent it out because the rents don't cover the mortgage. And so there's just like a lot of inventory that's kind of been piling up in the condo sector. And I still think that's an overwhelming trend over the next 12 months is that investors are seeking liquidity.
Cool. Thank you.
I think, I mean, that could play out, but everyone's expecting though is that there's still no recession. So if you do get a stable economy, or depending on if it's per capita GDP or just on an aggregate basis, then that will it still have to flush out the system. That has to happen, Steve.
Yeah.
But again, I mean, our view is consistent with this. The risk is still that we get a hard landing, not a soft landing. Not one of these enjoy the moments. And if that happens, then the number one word that Steve just shared with everyone is liquidity. There is zero liquidity if we get a hard landing. And then who takes the losses and all this stuff? You can follow the chain how it works. But this goes back to the commercial banks. Ultimately, someone has lent capital, either to the builder, developer, or so forth.
And so I do want to play on that thread a little bit, Keith, because I know, like I said, we get comments from all the Loonie Hour listeners and we appreciate all of them. And sometimes people say, hey, you guys are too pessimistic. What's a modest recession? They happen every 8 to 10 years, like not the end of the world. And I do push back on, I think there's a real probability that you do get that harder landing. I also wonder, Rich has talked about this a lot, the amount of fiscal spending, fiscal deficits that are trying to paper over any sort of downturn, not just in Canada, but obviously in the US, rampant immigration growth, again, in both countries. Does that kind of shield you from the worst, at least on a nominal basis?
I think the fiscal side, that would be reactionary. I mean, that's what you're going to think about, right? So right now, what are we running? A 40 billion? Might even be a $50 billion deficit by the time it's over, right?
Yeah.
And they took a lot of flack for running it. I don't even think that's passed yet, though, has it? Has that budget passed?
No, they split it out. I think they split it out. Remember? Anyway,
Summer
they split out the
vacation.
capital gains things from the rest of the budget. Anyway,
these guys are still in power for another 15 months,
year and a bit
minimum.
Hey, Jack, this is your chance, man. This is your chance.
Price caps? Oh, we didn't. Oh, sorry. I digress.
We'll go into that one as well. But no, back to the whole the conversation with this part is if we do get a hard landing, is there enough stimulus to sort of cushion the fall? And what I'm saying is usually the stimulus happens after the hard landing, right? So they're already trying to be preventive. So with the BOC cutting rates are doing that, and all the fiscal spending taking place. It's sort of in line with this. You saw all the final data for all the public service hirings over the last 9 years or 8 years.
No,
10,000 people last year. It's up 43% since they got into power in 2015.
Yeah, it's almost 50%, right? So when I joke about if I came in, I could fix everything one weekend. I would cut the public service in half. That's 50%, 50. But even that wouldn't be enough to get back to the original. So I'm going with a 75% job cut. I'm never going to get that job. But the point is to do this fiscal stimulus or to try to cushion that. It happens after, the downfall takes place. And you'll feel it coming, we're not there yet. Things do, as RBC said, it feels like a recession. So, but that is the trend we continue to go. So people always say, but Steve, you mentioned, hey, you guys are being too bearish, everything. That's the trend. That's where the trend is going.
Oh yeah, and I'm not saying that like as if I necessarily disagree with your views. I'm just, trying to play devil's advocate and push back on the other side and say, okay, well, what's the argument for avoiding your scenario, your circumstance? So let's, for example, that maybe the economy doesn't turn down as hard, maybe housing doesn't have a sharp crash, and it's just this modest, long, dragged out correction. Things of that nature where, yeah, you go through a difficult 4 or 5 years, but you kind of come out the other end. I don't know. I mean, I think there's so many different scenarios and hypotheticals.
I think we can get there. I mean, so let's talk about that for a little bit. I mean, first of all, it can't just be a Canadian focused, event. It has to be global. So I think globally, everyone just says, hey, we're going to have peace. So this war trend that we're headed towards, let's cut that off. That's done. And then let's start spending money towards more productive economic activities. And that's already started. The whole ESG, DEI stuff seems like it peaked, right? Rich mentioned that earlier. So that's another positive. And then the other part of it is, we have to get kind of better with lending, because there's still going to be a lot of bad loans on the books out there, especially in China, because we talked about that last weekend with Michael when we had him on as a guest. So there is a way to sort of stall this for a while. There is a path towards it, but I don't know.
Very narrow path.
It's a tight thread. You got to get it through, because on the top of a needle, Rich, there's a little hole. You got to get the thread through.
Hey, now
what?
To push on that as well, Keith, to say, again, you hear this argument, right? I mean, so let's market odds and everything suggest that Trump will be your next president. We'll see, but that's looking like the highest probability today. He certainly seems like a guy that if he gets into power, he's going to have his foot on the accelerator.
Yeah,
I mean, I don't know how much bigger a deficit you could run, but carry on.
Well, yeah, it's one. Yeah, I mean, he's going to cut taxes for some groups, but another interesting tax that I read coming from his policies or his policy team, whatever, will be a withholding tax, I think, on dividends and cap gains for foreign investors. So a lot of it is targeting the Chinese, because they are, if for example, a lot of Chinese companies, they don't have audited financial statements and stuff like that. But there is a lot of money. There are a lot of disadvantages to Americans investing in their own home relative to foreigners. So you're going to see a tax shift with that. And some of the estimates are up to $1 trillion will be realized by doing that. Now, from a global perspective, it still comes off the whole pot. Instead of one group paying it, another group is paying it. But you could see these moves, though, to be an initial, positive euphoria economic event, for the Americans. And then what happens 2 years later? Then it's, all that money has been made. So I don't know, Steve, it's going to be tough. And then here in Canada, which way do we go? I know which way the Brits are going to go, because, we didn't talk about their election, by the way.
No.
But sorry, Steve.
Yeah, no, I was just going to ask you just on the whole Trump thing. When, again, we've started up the podcast with him and we, chatted about the equity markets. And it seems like, we're seeing some reaction in the bond market as well. Right? That if this guy is going to put his foot on the gas, as one would expect, you're seeing the long end kind of blow out.
I think, you're right about that. I think, though, overall, it doesn't matter who's coming into power. It doesn't matter if it's the red shirts down in the US, the blue shirts in Canada, whatever shirt in Europe and so forth. We have this global debt overhang. And it's pretty hefty right now. So I think what Michael shared with us last week, I think we have 350 trillion now in global debt.
Yes,
3.5. Yeah, it's
just north of that.
Yeah, and we're at around 200 not too far ago. And
yeah.
you know,
Sorry.
anyway, Rich doesn't like that
Say
story.
it. Say it.
Say it, Rich. Spit it out. Spit it out.
You got to be careful. I think it's in the US, debt to GDP is about 120, 110%, depending on who calculates it. But household debt to GDP is at a 25-year low. And non-financial corporate debt is also very, very low, with interest rates that have been refinanced, which the massive amounts of corporates have refinanced and locked in interest rates at all-time lows. So we have to be careful about this, like, where these issues are and whether issues are not. Households' wealth is near its all-time high.
Rich, do you think the long end of the curve still continues to push higher?
Yes, because this is my view, and Keith doesn't like this, because I think that the only way any of this money gets paid back is that you inflate it away. And so if by cutting taxes and goosing nominal GDP growth in the United States, or by running huge budget deficits, which both President Trump and Biden did, that's a way of increasing nominal GDP growth and inflating that debt away. And don't get me wrong, I think Keith's right when it comes to the debt burden in Europe, where there's zero productivity growth, there's very little investment in non-frivolous stuff. There's very little growth, period. But in the US, you are having a rebound in productivity growth. The investments are going into infrastructure and information technology. And it's just those are different animals. And so in a sense, Keith and I seem to get to the same conclusion, which is probably positive for the US dollar, but we get there sort of different ways.
But that's why I was asking you guys earlier, right? With just like, is the US going to enter a recession? Can they enter a recession with his foot on the pedal? And obviously, if they do have that downturn, that just blows out your debt to GDP ratio even further.
I think probably can, but sorry, go.
Yeah. So you are right. I mean, it would just delay the inevitable, which would be a recession. Rich, we are saying the same thing, but the difference here is that with the crisis developing in this, as a sovereign debt market, government debt market, that's something where the world doesn't work. So that's where you do need to create a distraction. So it's one thing for a household sector to have a challenge, and that's what hurt the Americans, pretty hard back with their And where are we now in Canada with our household debt metrics?
Exactly, we're 15 years behind.
And it's even more severe from back then. So each country can be a little bit different, but again, our concern here with IceCap is that this soft debt crisis that people been talking about for a long time, that's what eventually breaks. And then for all the good reasons that you both just mentioned then about the US, it can get that, euphoria bump. It's great for the Americans, but it sucks capital out of the rest of the world. So it could be, really good or very positive, for the American side. And that could be quite negative, for the European side. And for everyone else. And all this is tied together. Now, with this, I mean, you probably saw, like, with the shift in potential NATO spending and focus by the Americans, shifting, to the east, where's China? And that's something that Obama started 10 years ago. He's down with that as well. And all of a sudden, the Europeans are saying, oh, wow, we have to do this ourselves. And, Poland is freaking out, of course. I think they're allocating 5% of their budget right now. So you're just going to have a shift in the world. And then you try to figure out, okay, who benefits from that and who doesn't. And that's what people aren't prepared for. And that's where we get pretty excited about.
It's just, and just to touch on that point is, I think the three of us are in unanimous agreement there is a global sovereign debt bubble. And so let's just play the hypothetical that this thing kind of erupts or destabilizes. You get a downturn this year, maybe next year. What is the reaction function from policymakers? I mean, is it not just control print?
That's exact. It's pretty easy to see because they'll QE all day long because they have to save. Rich, I'm talking. Pay attention.
Sorry. I'm sorry.
No, but jokes aside, if the bond market runs into a problem, there's four groups that get hurt with this. If banks go under because their regulatory capital is sovereign debt, they have to hold sovereign debt for their bank capital. Insurance companies, the same thing, they go under. Pension funds, they go under. So they have 30 to 40% of their assets in that market. And then, I like to say the fourth group who gets really hurt with the sovereign bond market going under. Do you remember who? Politicians, because they're going to lose their job, right?
Okay.
Yeah, and they really don't like to lose their job. So for that reason, it's like what you just said. The central bank is going to rush in, do QE to infinity. They'll buy government debt all day long to hold that value on paper, and then the risk will get shifted on the currency side, and that's something that Steve's talked about quite a bit as well. On the currency markets will likely reflect the proper risk in the world.
So in summary, it's all about time horizons and that assets are going to continue to inflate over time.
But there's another, I think so, but there's another scenario, which is we just sort of, and it's maybe the worst outcome because it doesn't, like, in a sense, a sharp shock is, promotes some kind of cleansing in the market normally until politicians mess about. But if we just get sort of crappy growth for a while, where you don't really get a proper exit of your cycle and you don't really get a proper recession, I mean, that's also a possibility. We've seen that before. And that's sort of a weird situation where profits are weak, growth isn't great, the central bank can't really dive in and print lots of money because we're not in a severe dislocation, and central banks and governments just run budget deficits because no one has the appetite for austerity. That's also a possibility.
But the challenge we have, though, we have this fantasy land type economic theory happening, and then the real world. So households and corporates, we live in the real world. And if someone goes under, what happens? You go under. That's it. They'll sell your net assets, try to satisfy creditors as much as they can, and then you move on. That cleanses the system. Governments, they don't play by those same rules, right? So they won't let you go under. Except Argentina, on a regular cycle. But
the central banks did buy corporate credit, of course.
Yeah, they did. Yeah, but they were selective, though, right? They try to decide.
Big guys. They only bail out big companies. They don't bail out small companies. I think that's what his point was.
Like I think when COVID came around, Dave Portnoy did more bailing out or help, for the small pizza shops, in the U.S., things like that. But but the government wasn't running in to directly bail out this and that. So again, people who think this talk of a possible debt crisis, bond crisis, I just think there's a very little appreciation for what's potentially going to happen, and it is not a non-zero event.
Yeah,
and you have to be positioned for it. If it doesn't happen, that's fine. Right, that's fine. If it doesn't happen, people are going to get wiped out, and so I think it's from a very insensitive investment manager perspective, we get excited about this because again, it's pretty easy to see where we could potentially go, and we keep saying hope's not a good strategy, but you have to hope it does. And I don't know how we get out of it, right? Because see, you just went through this scenario. Where the Americans could potentially, there are new policies coming up, they could just suck the capital out of the rest of the world. And that ain't good. China really struggles in that market. Yeah. So, there she was.
You should have an insurance hedge, but it just should not be the insurance companies.
Maybe. Can I bring in?
No, Steve is right and Rich is wrong.
Well, it depends. There's different types of. Anyways, can I just bring it back to Canada, if you don't mind? Just because I think that I think we don't frame our assessment of like an analysis of Canada in different ways. I mean, And I just want to provide context and a framework for like how we get what our view, which is there's like households, there's business investment, there's trade and manufacturing, which is related to business investment. Then there's the labor market, which is related to households, and then inflation, which sort of and monetary policy, which marries sort of all of those pieces. And then you've got the fiscal bit. And we can just quickly see that, for those who say, maybe we're a bit too negative on Canada, and Keith, that's sort of, I guess it sort of rankles me a little bit. It's like, if you look at households, super high debt, a weak asset base, let's say not such great wage growth, low personal savings, and there you go. So that's, and then retail sales and other consumption that's weak. Business investment is at a 15-year low and declining. So I've showed that chart many, many times. I will show it again. Trade is is okay, but massively sort of negative for our economy, excluding natural resources, specifically mining, oil, agriculture, and etc. And all the other consumer goods and most services are net negatives. And then manufacturing, we know industrial production's basically been flat for 10 years. Our capital utilization rates are falling. The labor market, we know unemployment's rising. And we know labor participation rates are relatively high, but employment to population growth is falling because we're importing too many people relative to the jobs that are being created. And inflation, which everybody is cheering about falling down, I argue when you have population growth of 3%, that's actually an indictment on your overall consumption. We have weak mortgage growth, we have weak credit growth, full stop, and we have our policy that I think, as you said, Steve, is behind the curve, which means it's too restrictive. So I would love for someone to write me an email to tell me the rosy picture for Canada to not hit a hard landing. I would love, I challenge, please provide. And so to me, that's where that's the framework in which I come up with my view, and that's how I get there. And then Keith's right. If there's an issue in the US and they suck even more capital, it means net federal FDI, which is a lot of it's from the US, will stop coming here. And we will send money there, and it'll hurt our currency, and on it goes. Sorry, that was my little rant I had to get out, because I'm curious where people sort of see the positives.
I think the path is there. I mean, I think if we do an enormous shift towards energy, food production, for export as well, away from all this stuff trying to stop it now, Canada can become a powerhouse.
Yeah, I agree.
The path is there.
The journey.
Just knock down the door, knock down, beat it down, kick it down.
Well, anything else? I think we kind of summarized the very somber outlook.
It's sunny outside. It's beautiful. And we're
sunny here too. And there's a Loonie Hour meetup tonight. What more could you not ask for? So by the time you're listening to this podcast, the event already would have happened.
That's right.
Oh dear.
We'll summarize
it. Future.
Yeah, we'll summarize the event and how outstanding it was in next week's episode. So you'll have to tune into that. And we'll have our BOC update for next week's episode. The Twinkie bets are out. Rich, hope you're stocked up, my friend.
I am stocked up.
There you go. All right. As always, guys, we appreciate the support, and we'll see you next week.